G'day everyone, welcome back to another episode of Spark Your Fire. I am your host David Shi, and I've got here with me as always our co-host John. How are you doing, John, today?
Hi there, David. I'm great. Yeah, really good. Beautiful sunny Friday. It's Friday, isn't it?
It is
Friday.
Friday, mate. You're losing
Yeah.
track of the week.
No, that's right. That's right. But everything's good. I'm really well. How are you doing?
Yes, very good, very good. We obviously just had our Easter break, so that was
Mm.
good. And looking forward to the Anzac break, which I think it's school holidays coming up soon next week. So
Yeah, starting today.
there
Got
you
one
go.
kid at home already. Yeah.
More time for the kids.
That's right. That's right.
But speaking of which, any goss, anything that you've been looking at around like your investments and I know you're a big gold guy. Like
Yeah.
gold's going up a lot. What's going on there, mate?
So you mentioned gold. That's very interesting that you mentioned that actually. So gold and silver are in a very, very interesting place. Now, you know what, we talk about gold a bit on this podcast, and
That's right.
it's a topic that I'm interested in, an asset class that I'm interested in. But it's a love-hate relationship because it's not always doing what John tells it to do. But over the last since February of this year, gold in US dollar terms has gone up nearly 20%. And silver's doing a massive catch up as well. So silver's under its 1980 price, to give you an idea of how undervalued silver is. And you need silver in anything. We've done a show about gold and silver years ago, actually. But gold and silver, gold in particular, because gold has run ahead of silver, but gold is achieving all-time highs every day. And as I look down at my phone and I look at where it's trading, it's up another sort of $20 as we speak. Now, it's volatile; it goes up and down, but gold and silver are on a tear. Now, you may have heard me talk about when gold's going up really, really abruptly. That's what they call a silent crash, which means if gold is real money and everything in our wallet is pretend money,
Yep.
that means everything is crashing in real terms. So gold is telling us, gold is like the canary in the coal mine, which is why it's such an interesting commodity to look at. I mean, if lumber or pork was surging, it wouldn't be telling us anything. But when gold surges, it's fascinating. I think when I say it's a canary in the coal mine, what I think it's telling us is that the central banks are doing the wrong thing. That when they tell us that they're going to be bringing interest rates down, that the market thinks that's the wrong thing to do. And you got to sort of look at the clues that the market's not telling you. There's no one Mr. Market. It's all of the prices in the economy. And I think that the gold price in particular is telling us that our currency is being mismanaged and that something is happening right now that the market doesn't agree with, that the central banks are doing. So it could either be that the interest rates are too high or that they're not high enough, and that the gold price is objecting to the rhetoric in the market. But fascinating. And what it means is, in real terms, all of our currencies are depreciating very rapidly at the moment. So that's another interesting component. So there's a lot of information in that one little gold price. It's telling us a lot of stuff.
Yeah. And you're talking about that's Fed, isn't it? Basically, central banks in US and in general, not in Australia, basically.
True. We blew past all-time highs in Australian dollars years ago. So the gold priced in Australian dollars for people like you and me has done really well. In US dollar terms, that's where it's hitting the all-time highs just recently. But gold has been a great asset in Australian dollar terms because our currency has lost so much value since about 2004, 2005. It's just been doing terribly since then. So, but look, the mother currency on the planet's the US dollar. That's the mothership. And when gold goes up, people usually referring to it going up in US dollar terms. So to answer your question more directly, yes, the central bank that's currently doing the mismanagement at the moment would be the US Federal Reserve.
But it could be anything, any kind of investment, because anyone can buy gold from anywhere across the world, essentially. So what you're saying is the inherent signal there is people don't believe what the central banks around the world is saying, that the interest rate should be dropping. Hence the reason why they decided to put the money into gold, which usually is the backer or the more conserved way of, like basically to get a return, right? So
yeah, it's original money. That's right. Either it doesn't believe them or it believes the central bank and it thinks it's a mistake. So canaries and coal mines have pop up all over the world. So currencies in most of the South American countries have been destroyed, and you see that in the gold price. You see it in Turkey, you see it in Lebanon, you see it in all these, and to a lesser extent, you see it in like Australia. Our currency has done very poorly, but gold will tell you that. The cleanest dirty shirt has been the US dollar and the US economy, and it's catching up with the US now as well. And I mean, it's hard to know what exactly, like it could be a coordinated attack by the BRICS countries in response to Ukraine. You never know. Or I mean, I still think that the biggest risk in this whole mud ball that we call Earth is still the debt. And so the debt has to prevail in the economy somehow, and it prevails in inflation and in the gold price. So
yeah,
I mean, that's So yeah, maybe the debt's catching up with us as well, and the market doesn't believe that the debt can be resolved without a crisis, and maybe that's what the gold price is telling us as well. It's a complex little yellow stone.
It can be as complicated or as simple as you like it to be. I guess it's depending on the on way how you interpret it. But certainly very interesting points, and appreciate you bringing that up, John. I think this is where we need to get Jazz back on with you. So
Yes,
the two masterminds can obviously have a good chat around the what that means and how that impacts the financial markets potentially.
Yeah.
So.
Look, I mean, look, gold is international money, but I do see it as not completely dissimilar from land.
Okay.
Not real estate, but land. So land and gold are very similar. They both have intrinsic value. They both just sit there and they absorb inflation. They're both hedges. Yeah. So gold and real estate, no, sorry, gold and land are very, very similar. I mean, gold is obviously portable, but apart from that, they're quite similar, and they're both unproductive assets by themselves. That's the other thing. So they're quite complementary.
Yeah. Good one. Okay. Well, look, as much as I appreciate, sharing about gold, and that's a quick update for our listeners, but this is a property podcast, predominantly. So I am going to bring it back into more of a property topic in that case. But look, I think one of the things that we want to have a chat today is that I think I saw on the I think it might be on the AFR the other day that the units prices or the units growth is now starting to catch up to the house growth level. So, okay, we know that units traditionally hasn't been as good performers in comparison to houses, and this is particular in Sydney, essentially. But I think one of the things we like to explore today is units now going to start outperform houses? This is future glazing stuff. It's future glazing stuff. Again, we obviously don't know what's really going to happen, but I thought that was an interesting topic for us to share some of our opinions in that sense. And so what do you think, John? Just based on that, your thoughts?
Yes. So historically, and it would be no surprise to our listeners, so historically houses outperform units, but not that much, but not by that much. I mean, they outperform, I think over the last 25 years in Sydney, capital growth for houses has been 7.6%. And for units, it's been 6.3%. So like a 1.3% difference. So that does accumulate compound over, say, 20 years of owning two assets. The house will definitely outperform. But I think it's also fair to say, and I don't have statistics on this, but it's also fair to say I think that since about 2000, since COVID, that discrepancy between the growth is far more pronounced than just 1.3%. So houses have grown considerably more. Now, during COVID, when they put interest rates to zero, that made sense. It made sense that houses would outperform units because when interest rates are zero, yield doesn't matter. And the yield on a house is much, much lower than a yield on a unit. So you're not really affected by the cash flow of owning a house versus a unit. So that made sense during the zero interest rate period that houses would outperform. But now that we're certainly not in a low interest rate environment, how do we explain why houses continue to outperform? Although it's far more subtle now. So the comparison. So And that's a more interesting question. So, what I think the answer is, do I think the houses will outperform units over the short period of time? No, I think there's going to be a rebalancing, and I think units will outperform moderately.
Mhm.
However, I do think that as our population grows and land becomes relatively scarce, I think houses are going to become like hen's teeth. Houses, land, and I think actually what population growth at this speed does, plus what a lot of the rezoning proposals from the state government will do is actually it will make houses a lot more expensive because
Yes.
the amount of density that can be piled on one little house or two little houses put together will make those houses more valuable. They will get demolished and made into units. Then you've got houses that aren't going to be affected by rezonings, but they're just beautiful houses in quiet spots. Well, they're going to be really desirable too. So my view is that houses are going to be, I mean, I think units are great investments. I don't have a problem with units. I think they're great, but I think houses will probably continue to outperform, but not over the next 2 or 3 years. I think over the next 2 or 3 years, units will do a bit of catch up.
Yeah. No, I think
Over to you.
I think you pretty much hit the jackpot there, John. With look, I think we're talking probably specifically more using Sydney as a bit of an example, because I know Sydney's the market that you know the best. But the differentials between Sydney house prices and unit house prices was about 70% difference. Was that right? Or thereabouts? Yeah,
in Sydney,
roughly
that's
around
true.
that. Yeah, that's right. So that's a gap that's too much, too big for everyone to handle. So, and that kind of shows, how expensive it is to be able to purchase and own a house on a block of land in Sydney. Okay. So and that's the issue. So just purely from an affordability perspective, because don't forget we are at, like you said, a very high interest rate environment at the moment. People's borrowing capacity has been dented big time, especially with the 4% increase, 4.1% increase in such a short period of time. Me as working as a mortgage broker, I see these numbers every day. And it has, the borrowing capacity has been basically diminished big time. So people used to be able to borrow a lot more. And when they come to us now and knowing that they can only afford to borrow maybe 30% or even 40% less than what they used to be able to borrow, logically speaking, they'll be looking at what they can afford. And that becomes units. Okay, that becomes units. So, or for those people who have actually owned houses or investment properties, they look at how they can sell down potentially some of their properties in order to free up the borrowing capacity so they can upgrade to better properties. Okay. But look, I would say because of the fact that statistics shows that majority of the people around Australia only owns one investment property. Like I think 9% of property investors only have one investment property whatsoever. So in that sense, logically saying it does make sense for people to be looking at units, especially when it comes to, affordability side of things. So there'll be more people that can compete in that units price range. And therefore, I think at least, like you said, in the short term, that's where majority of the demand is probably going to be.
Yeah.
And hence the reason why it's kind of driving up on that.
Yeah, I think I think you're spot on. There used to be the statistics, and you and I did this in a webinar years ago. We talked about when to buy a unit and when to buy a house, and the answer was you target units in suburbs where house prices are 3 times the median unit price. So, and you'd buy a house in the inverse, right? So you're looking for not the inverse, but you're looking for buy houses where the unit and the house prices are quite similar. So
correct.
The units where their houses are 3x the price of a unit, that's where you want to target a unit. And what that led you to was more premium areas, somewhere like Cremorne or somewhere like that they had house prices were 3x, 4x even the price of a unit. Certainly in the eastern suburbs, that was the case. Now, all units are 3 times price of houses are 3 times the price of a unit. So there's no, like, the rule of thumb is out the window. I mean, unless we adjust it to 4x. But as an asset class, units are just underpriced at the moment. I remember Tom Panos also saying something like, he said, "Oh, a unit in Sydney costs $650,000, but it costs you $600,000 to build a unit." So units as an asset class are grossly undervalued because they're basically at replacement value. That's what you can pick one up. So there's no premium in unit prices at all, which is an interesting way. I think you might be right, and I think that's a very interesting way to look at them. Yeah.
Look, I think absolutely. I think if you can buy something at pretty much at the replacement value,
which is what we're talking about. Yeah,
correct. That's right. So but yeah, I think that will be the main reason why in the next short term, likely in the next couple of years, essentially that's where the units, especially in areas like Sydney and Melbourne, predominantly units around in these 2 capital cities. That's where these units are really going to perform a lot better in comparison to houses. And look, and then also a second point in regards to your argument, well, your perspectives in around affordability as well, houses. You're right, houses are just going to get more and more premium because of the fact that there's going to be less and less of them in the long run. In fact, right now, like even if you're looking at, let's say, middle ring suburbs, Epping, Carlingford, Eastwood, that kind of area, entry house prices around 2 mil plus, and that's you probably won't even get much with that kind of price range, right? So, and with that in mind, like, to get a loan for that size, you're probably looking at someone with a family earning at least about $400,000 combined income in order to be able to borrow roughly 80% of that value. So how many families in Australia is basically be able to earn $400,000 combined?
I totally agree. And the other kind of crazy thing about this is that, and it's population growth is essentially like we are injecting or importing demand for property faster than we can inject supply of property into the economy. But you're quite right that if property prices aren't going up 6% or 7% evenly across all of the dwelling types, because if you double your population from, let's say, 4 to 8 million people, and you do that in 10 years, the price of scarce properties don't go up in a linear fashion; they go up in an exponential fashion. Right. So while Carlingford might go up at 7% per annum, Bondi is going to have to go up at 11% per annum because the demand is not linear for the places where there's no supply.
Yes.
And they're already desirable. So if you want to live on the water, you can't pay average. You're not going to get average growth rates. You're going to get above average growth rates. And I think this is what people miss. For desirable properties, the returns won't be linear. They will be exponential as we double our population.
Yes. And also, I think in the long run, properties like houses, for example, is just going to be something that only rich people can touch. Unfortunately, it's an unfortunate fact, and unfortunately, I think a byproduct of the capitalist society, in a sense, to a degree. Like, because only if you got the financial capability to be able to acquire these assets and be able to hold them long term.
Yeah. I mean, the alternative is no private ownership, though. That's the problem. Like, so I don't think there's a better system. Houses are very expensive. There's no way of getting around that. But I also think that part of the problem is a lot of our kind of culture. We have a lot of cultural problems. So the overconsumption, I think we get married too late, and I think all those sorts of things. I think they delay a lot of the home ownership side of things, and I think that's not capitalism's fault. But I think there are some, But I agree. I mean, the reason we have home unaffordability is also because we have very active central banks that they just keep. We talked about gold before, so it ties nicely into that, I suppose. But if we had sound money, you wouldn't have exponential price growth. You just have prices going up and down for houses, but we have central banks instead of free markets. So that would be my counter argument to. I don't think it's capitalism's fault. I think it's central banking's fault.
Look, I'm probably not saying it's a capitalist fault, but it's just an outcome of the society that we are in, where obviously majority of the capitalism, that's how it works. But yeah, I think the bottom line is essentially everyone complains about how expensive it is to get into the Sydney property, but it's houses in particular, but it's not going to get any cheaper. I think that's just the reality. And for those people who is able to play in that field, obviously they're just going to get richer and richer in the long run. So I think that's why they say the middle class is actually getting smashed and diminished, and they are diminishing at the moment, because either those people who can afford to play, like you said, in the premium type of areas, and they're just going to be able to compound their growth or more. Whereas the middle class at the moment is trying to get into the upper market, but if they are not able to, then they're just going to be staying around. But unfortunately, with high interest rate, they are getting smashed themselves as well. So they're moving more towards, unfortunately, the other side of the spectrum. So
I love it. Just add a footnote. So we've been living through. I mean, for most people, like I was born in the late 70s, but I don't remember it, obviously. So this is the first inflation that I've lived through, and inflation is the government's wealth redistribution by any other name, and you're either paying inflation or you're earning inflation to some degree, right? So, and so smart people know how to benefit from inflation, right? They might be Bitcoin owners, they might be real estate owners, they might be gold investors, they run businesses or whatever. But if you don't own assets, you're just a consumer, economically speaking. And so if you're just a consumer and you don't own assets, you're screwed whenever there's an inflation, and they happen. So this is because there is this pernicious inflation that's running through the economy at the moment, and the purpose of the inflation is probably to start liquidating debt quietly. If you're a consumer, you're paying it. You're paying the inflation. At least real estate owners who predominantly listen to this podcast would be paying in with one hand and earning inflation in the other hand as well. So you need to have these hedges in place.
Yeah, it's basically hedging against inflation. So that way, you're not losing out in the long run, because that's where the major differential is going to be 10 to 20 years down the track.
Yeah.
Which then I think it's a great segue as well, John. I'm glad that you bring that up, because another topic that I thought we should probably explore a little bit is should people looking to purchase today at peak interest rate? You mentioned about the fact that people purchase assets in order to hedge against inflation, and yes, it makes sense. But would you consider buying property in today's market, in today's current interest rate? Would you be looking at investing?
I'm a buyer's agent, are you? It's like asking the barber if you need a haircut.
That's why I need you to put your buyer's agent hat out and talk to me as an investor.
Yeah. Okay. So I think that there are some assets that you just need to own. And those assets include real estate predominantly, some gold. I think that a Bitcoin person would say you just need to own Bitcoin. If you don't have any Bitcoin, don't look at the price, you just buy Bitcoin, is what they would say, right? And they might be right. I think real estate's one of those assets. So whether interest rates are high or whether interest rates are low, it is a shock absorber for inflation. In fact, it attracts credit, it attracts inflation. So I think that you should own real estate. If you already have a big portfolio, then you have the luxury of waiting for the right time, though you never really know when that is. But if you don't own any real estate, you just need to buy, and you need to buy it as young as possible. So that sort of takes away this, do you buy now or wait later? Because the real estate market is a graveyard of people who thought it was too expensive now that they needed to wait for the right time. And you know them and I know them, and every real estate agent in Sydney knows, because they're the same people that have been going to inspections since 2014, telling them that the properties are too expensive and that they're going to wait. So yes, you should just buy quality assets. You should just buy quality assets. I had something else to say. I can't remember what it is, but what do you back to you in the studio? I mean, what do you think about buying? Oh, I remember, but I'll come back to it. What do you think about buying at in a high interest rate environment?
I want to leave a bit of a. All right. Look. Yeah, you're right. In terms of buying, my philosophy is always buy when you can afford, essentially. So, whether you're at the peak interest rate or not, I mean, that's speculation by itself,
Yes.
to be honest. But yeah, it comes down to your affordability. I need to put it at a very realistic level. When I look at people's finances every day, I tell them exactly how much borrowing capacity they have, and it's up to them to take that action. But from an investment perspective, you want to own it. You want to own it early, like you said. And look, to be honest, it's never too late. Like ties back to what we were talking about earlier as well. We're in a constant inflationary environment. If you don't own an asset, you're not hedging yourself against inflation, and the result can be quite dramatically different if you have owned an asset 10 years ago and today, as opposed to 10 years later or 20 years later. That compounding effect and hedging against inflation is really what's going to create the wealth in the long run. So yeah, I think a lot of people are thinking, should we be buying at peak interest rate? It's so expensive to get money. Look at my repayments. The property's not even positive. It's not even neutral. How long am I going to have to suffer in this? How long do I have to hold on in order to get a return on it, right? But look, putting that aside, I think it's just part of the psyche that an investor should have is everything goes in cycles. There are times where we're seeing the 2% interest rates, and there will be times where we see 6%, 7%, or even 10%, hopefully not in our lifetime. But, if back in the 1990s, it did go up to about 20% interest rate, which is crazy when you think about it. But it's all cyclical. So if you can hold out now, the rewards will come, essentially. Okay. So, and not to mention, look, the expectation at the moment for the next interest rate move is probably down, more likely down than up at the moment. We don't know. But, at least I think from the Reserve Bank's monetary meeting policy, they changed the wording slightly in this month, last month, as a matter of fact. So it was more kind of leaning more towards a neutral bias rather than a increased bias. So that is a big positive improvement in terms of sentiment. And I think if there is a bit more positivity coming out of that, it's going to start to spark a bit of fear of missing out, of FOMO again in a market. Okay, so again, I'm speculating a little bit here, but I'm already speaking to clients at the moment coming to me and say, I want to beat the rush. I want to get in the market now, and I don't want to wait. How can I get as many properties as I can before everyone else comes in? So, so if you look at it from that perspective, maybe getting in at the peak interest rate is not necessarily a bad thing, even though you are speculating a little bit. But as I said, at least you're in the market, you're playing the game, you're hedging against inflation. And if you can manage to hold out long term, you're not going to be in the losing position at all. So
yeah, no, absolutely. And if you don't own assets, you're just a consumer, economically speaking. I did remember what I wanted to say as well, and that is that 2023 was evidence that real estate doesn't just rely on interest rates. I mean, it's not this binary thing like a treasury bond where the price of the interest rates go up and the price comes down, and vice versa. Real estate interest rates went up the steepest they'd ever gone in history, or the fastest they've ever gone up in history last year, and yet property prices went up in Sydney 10%, in other markets more than that. So I hope that puts to rest this concept that property is just going to do the inverse of what the interest rates are doing, because property is far more complex than that. I mean, there are demographics, there are markets within markets. So that's the first thing I wanted to say. The second thing I wanted to say is I always sort of fall back on this spark your fire analysis that we present 3 times a year, which is real estate priced in gold. And check out our last video on that, because it goes through not only that, but every capital city. But if we price real estate in gold rather than in currency, real estate is, I hate to say it, a bit cheap, on the cheap side at the moment. And we discussed at the beginning of this call that the gold price is going up very quickly, which means the prices of everything else in real terms are coming down.
Yep.
So real estate is currently getting cheaper, not more expensive. And you've got to look through the noise of a fiat currency as a measuring stick. So yes, I think that's hopefully clears things up.
Very true. And that was a good good ad for the video as well. I don't know whether our listeners have already checked it out too, but if you haven't, I think it's probably in the last one or two previous episodes. So and there's a link that goes to the YouTube channel as well, so you can actually get to see the full video, including all the slides that John has presented. So, all right, definitely have a look at that. And is there anything else you want to add, John?
I don't think so. I don't think so. Yeah, let's talk about Perth and Brisbane next week.
We can chat about Perth and Brisbane next time, that's for sure. And we've got a couple more other different topics as well for our listeners next time. So, well, I think we'll wrap it up today. And for our listeners, thank you for joining us for another episode. If you got any questions, feel free to just drop us an email. Otherwise, have a good weekend, and we'll see you guys again next time. John and David, bye.